The Santa Claus rally failed. 3 consecutive down sessions during what's supposed to be the most reliable week of the year. The S&P closed at 6,896, the Nasdaq at 23,419, the Dow at 48,367, all red, all disappointing the faithful who expected their annual gift from the market gods. But here's what the disappointed bulls missed. This failure wasn't a glitch in the system. It was the system working exactly as it should. And if you understand why, you're about to see an opportunity that most traders will completely miss. I'm going to show you why this week's action was predictable, why it reveals a deeper structural shift happening right now, and how disciplined investors can position themselves while everyone else is still wondering what went wrong, because the market just handed us a roadmap. Most people just don't know how to read it. Let me establish something first. I've spent years studying how human psychology creates exploitable patterns in markets, not because I'm some guru with a crystal ball, but because human nature is remarkably consistent. Fear, greed, and exhaustion show up in price action with clockwork precision, if you know where to look. This week revealed something critical. We didn't see panic selling. We didn't see capitulation. We saw something far more dangerous: fatigue, the kind that emerges when narratives have been stretched across 12 months without meaningful correction. AI stocks that delivered triple-digit returns, Nvidia up 39%, Palantir up 139%, AMD up 78%, suddenly faced profit-taking not because fundamentals shifted, but because calendar mechanics demanded it. Tax loss harvesting, book squaring, reduced liquidity. These created a vacuum where even modest selling pressure moved prices through support levels with minimal resistance. The behavior wasn't emotional, it was mechanical. And that tells us everything about what happens next. Here's the first layer you need to understand: the human layer. Participants aren't buying conviction right now. They're managing exposure. The dominant emotion isn't fear or greed, it's caution dressed as patience. When you see 3-day losing streaks on declining volume, that's not aggressive sellers. That's absent buyers. Think about it. The S&P is still locking in a 17% gain for 2025. The Nasdaq is up 21%. These aren't disaster numbers, but they're also not euphoria numbers. The market is pricing in a soft landing that has already occurred, leaving little room for upside surprise and significant exposure to downside shocks. The Fed minutes confirmed this perfectly. A 9-3 vote split, the most dissent since 2019. Policymakers divided, uncertain, constrained by conflicting mandates. When central bank guidance loses clarity, participants don't speculate on direction. They retreat to cash or reduce risk. The Trump-Powell theater added noise but no actionable signal, reinforcing that political drama now competes with monetary policy for attention. Meanwhile, precious metals went parabolic, then crashed. Silver swinging 5% daily for 4 consecutive sessions. Gold hitting all-time highs at $4,579 before violent reversals. This isn't inflation hedging. This is speculative positioning meeting thin liquidity. When you see moves like this, you're watching leverage unwind in real time. Now the system layer. How these human behaviors create the patterns we can exploit. The 3-day losing streak occurred during the Santa Claus rally period, historically averaging 1% gains since 1950. But seasonal patterns lose predictive power when positioning is extreme and liquidity is thin. The system isn't breaking, it's recalibrating. Tech-heavy indices underperformed as AI names faced coordinated selling pressure, not from fundamental deterioration, but from mechanical rebalancing. The Russell 2000's 12% gain lagged large caps, showing that breadth remained narrow and concentrated. When your top performers pause and you have no breadth, the broader market has no support. The Fed expects 1 rate cut in 2026. Markets are pricing in 2. This expectations gap typically resolves through either economic data forcing the Fed's hand or markets repricing lower. The 10-year yield holding near 4.12% while equities consolidate suggests bond markets are skeptical of aggressive easing. Sector rotation stalled completely. Communications up 2.5%, Comatech up 25%, but real estate barely positive at 0.5%. This bifurcation between growth narratives and rate-sensitive assets creates fragility. The concentration in mega-cap tech means when the leaders stumble, everything stumbles. But here's what most analysts missed. Commodities diverged sharply. Copper's 10-day winning streak and 40% annual gain reflected real-world demand from AI infrastructure build-out. That's not speculation. That's tangible demand beneath the noise. While precious metals gyrated on positioning, industrial metals moved on fundamentals. The housing data showed this perfectly. Case-Shiller up 1.3% year-over-year, pending home sales jumping the most since early 2023. Rising prices with falling affordability, supply constraints, not demand strength. A market that can stall without crashing, creating a slow grind that frustrates both bulls and bears. This brings us to the action layer, the stoic response to what we're seeing. First principle, markets don't owe you a rally because the calendar suggests one. The failure of seasonal patterns is a reminder that historical averages describe probabilities, not guarantees. The system is functioning exactly as it should. When conviction is low and liquidity is thin, prices drift lower until equilibrium is found. This isn't dysfunction, it's price discovery in real time. The 3-year streak of double-digit S&P gains conditioned participants to expect continuation, but mean reversion isn't a threat, it's a feature. The easy money has been made. What remains is the harder work of identifying which narratives have structural support and which were momentum-driven. Second principle, don't predict which way the Fed expectations gap closes. Position for multiple outcomes. If the Fed cuts aggressively, growth assets benefit. If inflation persists and cuts are delayed, real assets and commodities outperform. The portfolio that survives both scenarios is built on anti-fragility, not conviction. Third principle, volatility is a gift, not a curse. Silver's 5% daily swings separate those with process from those with hope. The focus isn't chasing parabolic moves or panicking during reversals. It's position sizing that allows participation without catastrophic loss, understanding that volatility clusters create opportunities for those with discipline and capital reserves. Fourth principle, this consolidation is not a failure of the market, it's a test of participants. Those who chased momentum without risk management now face drawdowns. Those who built positions with discipline and maintained liquidity now have optionality. The market doesn't care about your year-end performance. It doesn't care about your expectations or your need for a rally. It moves according to the aggregate behavior of all participants, and right now that behavior is cautious, mechanical, and devoid of conviction. This is not a time for heroics. It's a time for patience, for maintaining discipline, and for recognizing that the best trades often come after periods of consolidation, not during them. Here's what this means practically. The AI names that delivered triple-digit returns now face the test of whether their valuations reflect future cash flows or past enthusiasm. Some will pass, most won't. The key is distinguishing between companies building real infrastructure, like the copper demand we're seeing, and companies riding narrative momentum. The precious metals volatility tells us speculation is still alive, but it's getting punished quickly. The housing market's mixed signals suggest a slow grind rather than dramatic moves in either direction. The Fed's confusion means policy won't be your friend. You need positions that work regardless of what they decide. The failed Santa Claus rally isn't bearish in isolation. It's a warning that when positioning is extreme and conviction is low, even historically reliable patterns break down. But that breakdown creates opportunity for those who understand what they're really seeing. The crowd expected a gift from the market. The market gave them a lesson instead. The lesson is this: when everyone expects the same outcome, the system finds a way to disappoint, not out of malice, but out of mathematical necessity. The participants who survive and thrive are the ones who built their approach on process, not predictions, on discipline, not hope, on understanding human nature, not fighting it. The year-end consolidation is teaching us that the next phase of this market will reward patience over momentum, process over prediction, and preparation over speculation. The question isn't whether you can predict what happens next. The question is whether you're positioned to profit regardless of what happens next. If you value systematic thinking over market noise, if you want to understand how human psychology creates exploitable patterns rather than just chase the latest hot stock, then subscribe. The link in the description contains the complete framework for building anti-fragile positions in uncertain markets, because while others are still wondering what went wrong, you'll be positioned for what comes next.